Hi everyone, Andrew Thompson here from JBWere's Investment Strategy Group. Well, the festive season's upon us, but markets don't seem to be in a very celebratory mood, with investors trying to determine what level of economic growth the world might deliver next year, what that might mean for corporate earnings, and how Fed hikes might impact it. Well, our recently released year ahead note outlines our view that while we expect economic growth to slow next year, it's unlikely to plunge and should remain solid at above long-term average levels, and we consider these to be more sustainable levels. And with still solid economic growth and a lack of imbalances in the global economy, the likes of which we've seen before the last couple of downturns, the risk of a recession in 2019 looks low in our view. And without a recession, and with still positive earnings growth and more fairer equity market valuations now, the risk of a sustained bear market also looks low to us. However, volatility is here to stay. We're just at that stage in the cycle where rates are rising and central banks are removing some of that accommodative policy that's kept volatility at artificially low levels over the last decade. Well, currently markets are trying to guess what the Fed will do next year, and that gap has re-emerged between the Fed guidance, which is for a couple of rate hikes next year, and the market pricing, which is for less than one. Now, we remain in the Fed's camp. We think the data supports continued hikes next year, but in saying that, they won't hike with blinders on. In other words, if this market turbulence continues and looks at risk of spilling over into the real economy, they'll likely pause. However, either way, this is shaping up to be a key risk for 2019, with that gap in expectations leaving equity markets vulnerable to be surprised by rate hikes. Outside of this, uncertainties around trade and China, as well as what's happening in Europe regarding Brexit and the Italian budget negotiations, are likely to keep markets on their toes next year. But you can read more about this in our year ahead. The New Zealand and Australian economies have broadly beaten expectations this year, with continued solid economic growth. Concerns around low levels of business confidence in New Zealand, combined with a slowing housing market in Australia, are both real risks in our view, but both of these economies continue to have plenty of tailwinds behind them, and economic growth should remain solid in 2019. Now, just finally on asset allocation, we're maintaining course for now and suggest investors continue to hold their recommended weightings in equities. We'll likely remove our underweight to bonds next year if bond yields continue to rise as we expect. However, the recent level of volatility is a good opportunity for investors to just think about their risk tolerance and reassess whether their current level of exposure to growth assets is right for them long term. And this is a conversation you can have with your JBWere advisor. And then finally, from everyone here at JBWere, we'd just like to wish everyone a very enjoyable holiday season and a safe and happy new year.